So biotech, kind of sneakily has started to get some traction and outperform. I mean, some parts of it really got overheated in early 2021. So kind of fell apart before the market did. Now recovering. What's to like about it? What does it say even about where we are in the cycle?
Yeah, I think that's the big one is, healthcare tends to do well on a relative basis at this part of the cycle. And, what does that mean? It means that we're probably in the contraction phase of, the economic cycle, at least as the market sees it. That tends to be bad news for energy. It tends to be bad news for materials, but it's good news for healthcare. We've already seen it in a lot of the pharma names, but, as you mentioned, just recently, we've started to see it pick up in biotech. Now, there's a little bit of a curveball here because biotech tends to be the more speculative part of the spectrum of healthcare. And that's not really where we are from a credit condition standpoint. But I like what we're seeing. And certainly, when clients ask us about tech and some of these other areas to be sniffing around in, we absolutely think that healthcare has a much better chance at this part of the cycle than, say, technology. And certainly, as we see breakdowns in materials, breakdowns in energy, we want to make sure that we're adding to our exposure in those healthcare names that are breaking out.
And just to drill in on that, I mean, you actually, were kind of ahead of the idea that the market months ago was saying this is a late cycle environment. Now implying we've tipped into something beyond late, so kind of, the end of cycle type of backdrop. So you'd think that energy and materials are basically busted at this point?
Yeah, I mean, energy is a tough call. I mean, we're a little flat-footed on that one because it hasn't really distributed like we expected to see. But without question, I mean, look at the copper chart, look at Freeport. I mean, those are top formations. Those are this tug of war that we had between bulls and bears for the last 6 months, rolling over now, taking out those necklines, taking out support. It's really very par for the course. It's following the script very, very well. And then just look at the 10-year yield, right? We peaked out around 350. We're down almost 75 basis points from that peak. We know just from our historical work back to the 1950s that energy, that materials, that yields will peak about 6 weeks prior to the peak in the data. And so far, that's really holding to script. And I think that's, an important message as we go forward. To Josh's point earlier, I don't think inflation is going to be the market's problem as we look into the rest of the second half of 2022.
Now, you mentioned the credit markets and what they've been saying, obviously sounding some warning about the macro outlook. At the same time, investor sentiment's already kind of on the mat, and you've seen a pretty good reset in equity valuations. How do those things fit together in terms of figuring out when, this kind of bearish cast of the market might be working its way through?
Well, I think you understated it. Bearish on the mat. I think it's pinned and, probably cemented in there. I mean, sentiment is by far the most bullish thing that we see for equities right here. And so, we always try to look at what is driving sentiment. Is it the Fed? Is it inflation? What is that? And I think you hit the nail on the head that's an important part that's probably pre-discounted. I do concern myself with the idea that we're not seeing any type of relief in the credit markets yet. And they don't have to lead, but usually they're in sync with the equity markets. And we just look at high beta versus low beta, and that's not playing itself out yet. So I think the one distinction that really almost all of us that are in the business still haven't really seen is a bear market ending when the Fed is still tightening. That's a pretty unusual circumstance. And when we look at where we are in our market cycle clock, usually growth has really taken a much bigger hit before we have some type of equity market bottom historically. And this is data going back to the 1940s. So I still think that there's a little bit more there. I like sentiment. Sentiment to us is like valuation. It's a conditional factor that supports a bull phase. But until you see momentum, until you see some type of definitive change in trend, I think you have to be a little bit more cautious. And that still steers us more towards defense, of which healthcare is a part of that. Versus cyclicality. If we started to see an improvement in things like discretionary, a big improvement in things like financials, those are early cycle sectors. We're not seeing that yet, but those are things to be watching for in terms of a turn where the market's now saying, hey, we're close to the growth trough and looking at that rebound.
All right, good stuff to look for, Jeff. Really appreciate it.
Thanks, Mike.
See you soon. Thank you.